one of the phenomenons that we've seen with our clients is one, they've racked up a lot of debt. Some of that credit card debt, they're paying 20% plus. So even at higher rates than you're able to give them now, a refi with a cash out makes absolute sense.
Made Easy podcast. We're here with my friend Maria Rini, who is a great Northern New Jersey real estate agent. She specializes in Bergen County and surrounding area. And we were having a conversation about refinancing, and I wanted to bring that back online so we could share this with you. And here's the thought. So many of our clients bought homes in, let's say, between the middle of 2023 and July of 2024, that year and a bit, when the rates were in the sevens. And there were some periods before that where we had rates in the sevens. And I'm saying that those people should strongly consider refinancing. And they should, because if you took a rate out at 7.25%, and if we can get you a rate that's 1% or more lower than that, then you should lock in your savings, even if there's a potential for rates to go down further, because it's like a bird in the hand kind of a thing. Does that make sense?
Absolutely. Absolutely. You know, David, we've got the last, we all know the last couple of years have been challenging, strange, different. One of the phenomenons that we've seen with our clients is one, they've racked up a lot of debt. Some of that credit card debt, they're paying 20% plus. So even at higher rates than you're able to give them now, a refi with a cash out makes absolute sense. One of the other things that we're seeing is as home prices go up and the next generation comes into the market, there are families who want to help their kids out, help them get into a house. And their homes have ratcheted up in value. So they're sitting on this pile of equity. You can help them tap into it. So a refi is, the answer. The money's sitting there in their house, not working for them. This is one way to help kids get in a house and have their equity work for them.
Yeah, let me just pick up on each of those things, because there's one more, but let's start with the first one. I have a client whose current mortgage is in the low threes, and we are refinancing her into a mortgage that's in the fives, but we have a bolus of debt. We've got this big glob of debt that she has to pay. And the only way to get around it, the only way for her to catch up and get ahead, is to do a refinance, get all of the money, build a reserve chest so that she can start breathing again. And she's probably on a cash flow basis, month to month, saving money. But more importantly, the whole picture makes sense. And that's what you have to look at sometimes. But let me take the second thing, where you're talking about a parent helping a child with a down payment. That's a great example. Often those parents have very low current balances on their mortgage. And so I don't know if you can hear the ambulance just go by. I'm sorry.
No.
Oh, okay. So the mic is better than I thought. So quite often what you have is a parent with very low debt on their home, but not a lot of cash, and where they want to help their child with a down payment. The third story is my favorite story. how many of your clients are thinking about moving, let's say buying a home in Delaware, buying a home in Florida in the coming years? And so they want to buy that house. Today, that house in Florida is a second home, right? Because they're still living here, they're still working here.
Yeah.
Now, what you want to do is you want to figure out a way, how can I buy a house? Let's say I may have $50,000 in the bank. I may have $100,000 in the bank, but I want to buy a $500,000 home. And in 2024, as we speak, the rates on second homes are much higher than the rates on first homes, even first home refinances. And so what we do is we blend it. We look at it from a family perspective, or if it's someone buying their own second home, we look at and we say, okay, if I take let's say my home in Bergen County is paid off. Let's just use that as an example. I have a $1 million house in Bergen County, and I want to buy a $500,000 home in Florida. Well, what we might want to do is take a $250,000 loan in Bergen County, take a $250,000 loan in Florida, and their total monthly cost, the total upfront cost of borrowing, and the total monthly cost for the two mortgages could be a lot less than just taking a larger mortgage in Florida. And so that's the kind of financial engineering I love, because it turns into a game.
I know.
And
I
you
know
do that
you
with
do.
parents, and you do that with parents and kids. Well, how much did you want to give your kid? Well, what if you gave them, instead of giving them 50, what if you gave them 100, and then you had an arrangement? Maybe that would reduce how much you're going to give them ultimately on their inheritance or whatever, so you're fair to all the kids. And we've had a lot of fun playing with these kinds of things.
Yeah. So just a couple of points on both of those. In the first scenario where they're buying the second home, we're seeing a lot of this. So when you're contemplating, hey, we want that home in Florida, that's going to be a retirement home. Prices go up, you lock in now. You've got the flexibility to rent that home over the next couple of years and maybe help supplement what it costs to carry that home. So brilliant. And I love too the gifting or lending to the child, as the case may be. It's because prices. I mean, if you look at any kind of a graph over time, real estate prices go up. There's not a whole lot of variation. With the last crash being an anomaly, really. But the time to do it is now, and with refi rates as aggressive as you can get them, it does not make sense to wait.
So I just want to share with you, we have a client, a young man who's just finishing his medical training, and in 3 or 4 years he's going to be really set. He's going to make a lot of money, but he barely had enough money for a down payment. And what happened was dad came in and lent him. So let's say he was buying a $700,000 house, and he had 50,000 of his own money or something. And dad gave him a little bit of money. And then we got him a $300,000 mortgage, and dad gave him a second mortgage at dad's cost of borrowing. And now everyone was ahead, because dad's going to make more money on the money he lent his son than he would by leaving it in his bank account.
Right. Right.
Right. So dad didn't have to borrow in that case. He had the money, in his whatever account. So he took 300,000 or 250 or whatever the number was, did that as a second mortgage. So now the son's borrowing $500,000, say, but he's borrowing 250 from the bank and 250 from dad, interest only. And then when the son graduates and where everything comes together, and now then the son will pay everything off. Dad's happy because he, in the interim, he made a good amount of money, guaranteed, blah, blah, blah. Son's happy because he was able to buy the house. And, it's a way of families enriching themselves together.
Yeah. And David, that's like a beautiful example of why you want a seasoned problem solving professional like yourself to look at a situation. That's not something the guy who got into the business last week is going to be able to engineer for somebody. And the way you can be so creative with solutions, you look at, you're a problem solver, you look at what the individual has to solve, and you figure out the way to get there, conventional or not. You figure out the most effective way to get there, and you're just a great resource.
Well, thank you. This has been a lot of fun. So this has been the Mortgages Made Easy podcast. We've been joined by Maria Rini, who's a great realtor in Bergen County. Her information will be included below. And thank you so much for joining us. Maria, thank you for joining us.
Well, thanks for having me, David.